and then it bounced in there, and then it did a brief spike out of this range, and then came right back in. And it held this huge trading range position at which point it could have gone at any price in the 117 to 111 range for practically 7 months. And at the end of the 7 months, when it broke out and fell back into this range, there was a fundamental change in what was going on that started to drive the price up. We had a non-spoken policy of keeping the dollar weak so that we can continue exports. The euro started to become the preferred investment of foreign countries, and a lot of fundamental changes in how the euro currency was viewed versus the US dollar started to happen. And as I said before, futures markets tend to trend very strongly when they break. And sure enough, for the last 3 months, 4 months, it continuously trended up. So this is something to definitely watch out for when you see large channels in contracts and how they're trading and when they break out. Because even though you may not know what the fundamental difference is, it's happening anyway. Here's a great chart of corn. This is a March 2004 corn contract. And if you look at here, it had about 1, 2, 3, 4, 5, 6, 7, 8 different times where it touched the top of this huge support channel at 254. And it broke through the channel at 236 3 times. But it came right back in and stayed in that trading range since March of last year. You're looking at a 9-month pattern where the price just rolled in between. If you were a short-term trader, there were some opportunities here, but because the market just really wasn't giving you a direction, you could have definitely been hurt. But as we see here in the beginning of 2004, there became a fundamental change, so much that corn gapped up on the next level, breaking out, and started off at a new level at 262 per contract, $2.62 per contract. Very huge fundamental change in which soybeans were not being traded, and most likely a shortage in corn was happening. And it's good to look at these channels to find opportunities for yourself when you decide to trade futures, because when you see these channels, you can put buys on breakouts and sells on breakdowns, and pretty much be confident that when it does so, the trend will continue with momentum in that direction. So it's very interesting. We talked about major supports. Now we'll look at some of the minor supports, and I like to look at minor support and resistance in 3-month, 4-month increments. And on this chart, this is live hog. On this live hog chart, there's several points where you have huge bands of minor resistance. But we'll look at just these 2. And again, you have to remember the reason why the prices are this way are because the hedgers are keeping it that way. They run the market. They decide where they want to go, whether they need to protect the market from going too much higher because they have live hog and they're selling it at a particular price, or whether they're afraid the price is going to go too high. And so with their heavy hand, they maintain these tight ranges. And only when changes occur do they start breaking out. And as we look here, the reason why in the first red square, we see the market breaks down, finds itself a channel, and then this is between August and September, it starts to shoot back up and trends and continues to trend upward for a little while, approximately 2.5 months, 3 months. Well, the reason why this happened, the breakout happened in this instance, is we found out about the mad cow disease in Canada in July, and people just began to substitute live hog for live cattle, and we'll talk about how substitution works with futures. But these are small channels, and when you see these channels, really understand that the hedgers have determined the prices that they're willing to buy and sell at. And when these things change, they're going to run straight on out. Now, sometimes the channel breakouts happen because of fundamental demand between 2 substitute products. And last year was definitely a year of just fundamental change between substitute products. We saw the US dollar and the euro currency swap places. We saw live hogs be substituted for live cattle, not only with the American mad cow scare, but also with the Canadian mad cow scare. And then we see two products that are always perennially switching places, because soybeans and corn are so interchangeable now, and people are relying more on soybeans for cereals and grains and nuts and even as sweeteners, that corn and soybean are battling it out constantly. And let's look at a few of the charts associated with these. This is a dollar index chart versus a euro currency chart. Both of them are March contracts. And the red circles and the blue circles represent different times that they were substituting each other. And as we look, the red pattern represents the euro currency, and the blue pattern represents the dollar index. While the dollar index was high, we see almost identical in width and distance that the euro currency is low. And so it's a direct, just a direct effect of people substituting the dollar for the euro currency at that time. And as we see the dollar continue to go up from the first red circle to the second red circle, we see exactly the same width and distance, the euro currency falling. And this shows the interdependence and interrelationship directly that the euro currency and the dollar have. Then they start converging, where you have institutional investors and hedgers, the banks, the major money managers, the major Fortune 500 companies that need to trade in euros and or dollars simultaneously, start driving the prices towards a median, in which they have a huge swath in which they start trading between each other. And this goes on for from October to December, so about 2 months. And in that period, the dollar has dominance for most of it. And then we see a fundamental change in which the euro currency begins to be accepted as a substitute on the world marketplace instead of the dollar. And we see the euro currency break out of this trading range, that's basically a shared support and resistance channel, driving straight up, and the dollar following exact suit and driving straight down. So apparently these two currencies are definitely have an interrelationship. And it's very unique because this has never happened before, where you have two very dominant currencies which are driving and fueling two major economies that, for the most part, are on an equivalent scale. So when you look at this, realize that you have to not only look at the one chart of what's happening in the euro currency, but you also have to look at the dollar index to really get a feel for what's happening and what fundamental changes are going on. And you can also look back at some of the fundamentals we mentioned earlier. This is an example of a corn and soybean interdependent relationship. Corn and soybean are constantly being traded back and forth. They're both used as meal for livestock. They're both used in all types, like I said, as sweeteners and all types of food products. And so when one is cheaper than the other, we start to see strange relationships happen. Now in this chart, we see last May, corn had huge highs. It actually reached new highs up until that point. And we see as corn is reaching new highs and with a lot of erratic behavior, soybean starts to gain momentum and starts becoming more and more of a good that's getting bought. But it really doesn't have a breakout time period. Then you see those commercial hedgers drive the price of corn all the way down to the same level as soybeans. They start selling off corn because soybeans are just simply cheaper. And those people who can use soybeans sell the corn and begin to buy into the soybeans. And we can see their pattern because when they start buying into the soybeans, soybeans make a straight beeline curve up. There's a lot of erratic behavior in the corn. Corn continuously tries to keep up. And then there's several points where you see soybeans and corn intersecting and one being ignored for the other. Then, as we get closer towards the end of this interrelationship, we see that as corn is making new lows, soybean starts to find a halt. It stops moving in the blue area, the blue circle on the red line, and then the red circle on the blue line. And then immediately corn shoots straight up to match what's happening in the soybean market.